this is especially important if you're a growth investor in a market crash, because what tends to happen is if you're searching for perfection in that environment, you will never get it. Because let's take COVID as an example. So during COVID, I had a bunch of companies that I was looking at. One of those companies was Square. And this was maybe, let's say, 200 or 300% ago, to be generous on myself and kind to myself. And of course, I didn't buy it, by the way. So I looked at the company. I was like, oh, well, I need to look further into these trade receivables. Oh, I need to look at this non-balance sheet. What is this liability? Oh, I need to look at this. And I couldn't find the answer. So then I was like, well, I just wasted, a week or 2 weeks looking at this company, and I made a decision not to go ahead. I should have either been more prepared, so we would have had that watch list like you've got, or I should have just said to myself, I'm just going to buy a little bit, and I'm going to accept that there's a lot of uncertainty right now. Because, like, for example, let's say even if your company reports quarterly, and so you've got the quarterly to the end of, I don't know, September, and the market crash happens in October. You then have the most recent set of financials, but you still have so many questions in your head. You don't know what's happening at the moment. You don't know if COVID's going to be a pandemic or if it's just a thing that's in China, it's whatever. And so I would say, don't search for that guaranteed, okay, this is an absolute no-brainer right now in that environment. One of the ways you can help yourself behaviorally is having that checklist. So just some of the things that I would say to add to your checklist. If you're in that kind of, oh my God, the world's crashing around me, find companies with rock solid balance sheets. Oftentimes, the kind of the assets are what save a business. So in that worst case scenario, you've got cash. What else have you got on that balance sheet? You don't want a lot of long-term debt. You don't want a lot of, especially you don't want a lot of short-term debt. Short-term debt is the one that gets companies. You want high retention rates. And we talked about in a previous episode, we did a separate snippet of this, the SaaS metrics. I know you've talked about this a lot, dollar-based net retention. Basically, how much do customers spend on the platform next year versus this year? Really important, because it shows you if it's mission critical. If this is a business that is a reliable business, people pay it rain, hail, or shine, that's okay. Like an example would be, maybe don't buy a discretionary company, say a company that sells electronics. Maybe buy a company that has the software embedded in the retailer's ecosystem. So they're still paying that software cost every year. Make sure you have aligned management. You want management that is still visionary, because I think it was, I'm going to mistake this, but maybe it was the Blackmore CEO, or maybe it was someone else that I was thinking of at the time, basically come out and said, never waste a good crisis. And if you have a CEO that's in a market crash says, I'm not going to waste this crisis, you know that they have the right temperament to be a long-term capital allocator, because they're the ones thinking, hey, there's bargains everywhere. Let's go out there and do some shopping. We've got the balance sheet for it. And the final thing is, look at that income statement and just have a look at it. Is it a high quality business? Meaning, does it have good gross profit margins? Is revenue growing consistently? Are the costs under control? These are just some of the things you can do. When I had Andrew Page on for a chat during coronavirus, he basically said, there's two questions I'm going to ask. Does it have a rock solid balance sheet, meaning cash on the balance sheet? And do I think it can survive 2 years, at this cash burn rate? And that was his criteria. And I think that's a kind of simple yet eloquent checklist. So I think that's a way to do it. Is just have that checklist, have the spreadsheet. I think it's a great idea. We've got a watch list. You've got a watch list. I think it's a great way to do it. And just in case we're at risk of leaving people on a sour note today, does long-term investing work, mate?
Oh, long-term investing works. I was going to double down actually on one point that you made, which I think is really, really important. Which you said, you basically if people get caught up trying to make all their decisions right, then they don't take any decisions right. So you just have to allow for the fact that you get some of them wrong, and that's okay. And you also alluded to the fact, start small, for example, add over time. I think those are things that I think really work in your favor. So I think that's really, in terms of long-term compounding working, it absolutely works. What I like to say is that it seems like it's not working for the first few years. The first 5 years kind of is like hard work. Then you start seeing some results, from year 5 to like year 10. Year 10 onwards, it could actually be just like, it's almost like an autopilot because, I tell people, save furiously if you can. And it's just a saving as a habit, because you need to save to invest, then invest furiously over time, let's keep doing it. And this cycle can be very, very powerful, right? A couple of percentage ahead of the market. If you do 10%, 11%, 12%, if you're doing 15%, you're doubling every 5 years, right? If you're doing 20%, you're doubling every 3.5 years. And if you do 15% actually is like in over a period of 30, 40 years, it's phenomenal. It's life-changing. It's massive. So
absolutely it is. I think that's it. In that first 5 years is just getting that shovel. It's not so much about necessarily what you buy in the first 5 years if you're on this journey. It's about just getting the money, putting it to work, and then letting that time do the heavy lifting. And basically save hard, save early is the kind of the mantra there. Just save hard, save early. If you're in a relationship and you're saving together, then make sure your partner understands the power of compounding as well. And I think if you put that down in a spreadsheet, you create your watch list, you use a checklist, you control your emotions, you can really take advantage of market crashes. That's the power of a watch list. It doesn't stop, we don't have to wait for the next market crash. I think people that say that, the people that say, oh, I'm going to wait for the next market crash, are the same people that in the market crash say, oh, it's too scary to invest now. I'm going to wait until things look a bit better. And that just doesn't work. I've never met anyone that says, oh, I'm going to wait for the next market crash and then actually puts their money in. I don't think I've ever met someone that does that.
You can't time the market, right? And the other problem is that, market might say, the market that says in $1 as an index, then goes to $100 and then maybe drops to 90. You missed between the 1 and 100 and then you got in at 90, right? So that's the problem. You really don't know what the top is. You really don't know where the bottom is.
Yeah, that's it. So just disciplined saving and investing. Let time do the heavy lifting. Find great companies and add to them. It's as simple as that. Find the 2 or 3 good metrics that you want to follow that are relevant to the company. Like you said before, the size of the market, total addressable market, TAM, relative to the size of the company today and its revenue stream. And I think that's just a really good yardstick for a lot of these high growth businesses.